Hello traders! Do you know how the best prop traders manage the risk with the dynamic risk management? Stay with me for a few minutes and I will give you a great tips how to not be stuck in the trading challenge, how to pass the verification phase quickly, and how not to lose your funded account. The risk management is a key. We all heard about a 1% risk per trade, but have you ever break it down for the prop trading? In my opinion, it's still quite high risk. Let's say you have backtested your strategy and you got your winning ratio 60%. But still, this is just a backtest. In the reality, when the emotions and the discipline hits and affect your trading, the results can be slightly different. So let's look at it again. 60% winning rate. It really sounds great, but what does it really mean? It means that out of the 10 trades, I should win 6 and lose just a 4. This is good. But is the 10 trades really good enough data sample? Let's look at it from the perspective of the 100 trades. It should give us much better data, right? So we've been speaking about the 60% winning ratio, which means that we should win 60 trades out of the 100 and have only 40 losses. But we need to calculate with the variables. We never know what will be the distribution of the wins and losses. In the perfect world, we would get 1 win, 1 loss, 2 wins, 1 loss, 3 loss, 5 wins, and such distribution of the outcomes of the trades. But still remember, there is a 40 losing trades in the 100 trades. You never know when you're gonna get 10 trades losing in a row. This can happen, and if you're trading long enough, I believe that it already happened to you. But does it mean that the strategy is obsolete and you need to change your strategy? Definitely no. This is the normal sample of the distribution of the losses, and right now I will show you how to deal with it. So if we're speaking about a prop trading where the maximum allowed loss is a 10% of your equity, that means that if you are risking 1% per trade, 10 losses in a row will simply kill your account. So right now think about it. Do you want to risk your prop trading career just into the 10 trades? Obviously not. And also, you don't want to risk such a small amount per trade that your trading challenge will take for the years. So I will show you a dynamic risk management which will help you to pass your challenge quickly and how to behave on the funded accounts. So finding the balance between risking too little and risking too much is a key. Both extremes have their downsides. Risking too little can lead to the prolonged evaluation phases which we don't want to, and risking too much can lead to the blowing your accounts and struggling with the emotional aspects of the trading. Therefore, we must employ a dynamic risk management which is adjusting a risk per trade based on our current drawdown and emotional phase of the trading. So now I'm going to introduce you a dynamic risk management with the specifics for the challenge phase, verification phase, and the funded account. Challenge phase. In this phase, a 10% gain is required, so we do not want to be stuck in this phase for a long time, and also we do not want to gamble it. So the following rules are applied. We start with risking 0.5% per trade. It allows us get a 20 wrong trades in a row, which is still quite good buffer. But if we start losing and our drawdown goes below 3%, we reduce our risk just to the 0.25%. If your drawdown is below 5%, we increase our risk to the 1%. Now you might wondering why increasing risk when I'm in 5% drawdown already. It's simple. It's to minimize opportunity risk. I will rather increase a risk a little bit to attempt get to the break even quickly or lose the challenge fast, because you don't want to be stuck in the challenge and trying to recover it for the half year. If you cannot afford to lose the challenge, stick to the 0.25% risk per trade until you break even. Also, we want to pass a challenge phase quickly, so once you get into the profit of the 3%, so you basically create a buffer, then you can start rising your risk from 0.5% per trade to the 1%. So you can get quickly to the 10% gain. But again, if you lose and you get to around the break even with your equity, you need to reduce your risk. Second phase, verification. This is when we already passed our first challenge phase and we do not want to be so aggressive or dynamic with the risk management. Because we already passed the first phase, in the second phase we are going to use a little bit cautious approach. Because if we lose in the second phase, it will cost us time and we will need to repeat the challenge again. So the numbers are following. It's very similar to the first phase approach, but we will not be increasing our risk when we go to the drawdown more than 2%. If you get to the 2% drawdown, drop your risk per trade to the quarter per trade and stick in there until you get back to the break even. If you gain 2% profit, don't increase to the 1.5% per trade as the first phase, but just to the 1% per trade. But if you lose it back to the break even, just drop it to the 0.5% per trade again. And finally, funded account. This is the stage when we passed our challenge, our verification, and we got the money for the trading. So our first goal should be to protect the capital and make it to the first payout and the refund. In this stage, we are not going to be increasing our risk per trade at all, because you already did a lot of work to passing through the challenge, then through the verification, and you don't want to lose the funded account. You will rather be trading in the drawdown with the less risk until you trade to the break even. So the numbers for our risk management will be as following. You start with the 0.5% risk per trade. If you trade to the drawdown of the 2%, you decrease your risk per trade to the 0.25% per trade. If you trade into the drawdown above 5%, we're not increasing to get out from the drawdown, but we also again decrease our risk per trade to the 0.15 per trade until we trade back above drawdown to the 2%. Then you can increase to the 0.25% per trade again, and you're trading with the 0.25% risk per trade until you trade to the break even. Then you start with the 0.5% again. In this stage, we are not increasing our risk per trade if we are in the profit, but every time when we are in the profit and we are eligible for the withdrawal, you take the money out. I hope that these trading protocols for the specific stages of your prop firm trading journeys are helpful and easy understandable. If you didn't understand anything, you can go to our website, because I brought also a nice blog where is everything explained in the details, so you can use it for your advantage. To summarize this ultimate risk management guide, you always should be thinking in the terms of the probabilities and the long-term process. Ensure that you have always enough bullets to trades and shoots in the future. So don't risk 1% per trade. It can be really a lot unless you are a very efficient trader. And your main objective as a trader is consistency, but not only in a trading, but also in a payout frequencies. Okay guys, so let me know in the comments what you think about a dynamic risk management approach. Let me know about your approach. If you enjoyed this content, hit the like and don't forget to subscribe for the more prop firm trading content.